It's 5:32. We're going to call the meeting of the Pension Board to order. I started the recording. I'm going to ask Alan Baker, who's the ranking seated member of the board, to chair the meeting in the absence of the chair. Alan, the floor is yours, and I'm going to mute so I'm not a distraction.
Well, thank you ever so much. And now I'll pull up the agenda because I wasn't actually paying much attention. Yeah, great. Getting there. Anybody got a copy of the agenda? You want to help me out here while I get that out?
Yep.
Or you're all gonna
Next three items: regular meetings, special meeting, and regular meeting. Approval of minutes.
Hold on a second.
I move that we approve the minutes as submitted for all three dates.
Second.
Okay, is there any discussion? Hearing none, I'll call for a vote. All in favor of approval of the minutes?
Yes.
Aye.
So that is the three of us.
Actually, one short of a quorum at the moment. I'm trying to get Fran in.
Okay. Well, then let's wait and close that here.
Alan, next item on the agenda is public comment.
Well, thank you. Getting there. My PC, of course, in this shows this moment to be pain. Do we have, no, we still don't have a quorum. Okay. Okay. That's good. Actually, we'll give it a second here while I my act together.
She emailed the group and asked to resend the link, so I just sent that. I expect she'll be joining momentarily. Here she comes. All set, Alan.
All right. So we had a motion and a second to approve the meeting minutes of the previous meetings. Fran, I don't know if you had any discussion on those, and if not, we're in the midst of a vote.
Yeah.
And everybody has said aye so far.
Aye. Sorry.
Okay, so moved. Now we have public participation. Is there anybody from the public who wishes to address the board? Okay, there's none. I'm still getting myself together over here.
Next item is the pension update, if you can't find your agenda.
Okay, good. I guess we can move on to the pension update. By the time we're done with that, maybe I'll have myself together. So who do we have to discuss that?
Well, Bob LaBrue is on for Webster. I believe Bob Maglio is here as well.
Yep.
And I assume that everyone can hear us?
Yes, we can.
All right, perfect. Well, let me start off. let me just say that the markets continue to move forward based on a very optimistic backdrop that includes fiscal stimulus, certainly the improvements to the vaccine distribution have played a major role, certainly in the last couple of months. And we continue to get strong economic news from several fronts. We saw our recent reading on non-farm payrolls was up over 900,000. Our unemployment rate has dropped to 6%. Manufacturing continues to soar with ISM readings that exceed the mid-60s. Consumer confidence looking out a number of months continues to be high, all along with a Fed who continues to maintain an accommodative monetary policy. And of course, we've had a lot of fiscal stimulus, as you know, and now we're discussing an infrastructure bill, which should help carry, this into 2022 and 2023, in our opinion. So, it's good economic movement, trending in the right direction. The market has reacted, as I'm sure you've seen. We don't have double digits this time, but still the S&P was up 6.17% for the quarter. Pretty good quarter. International markets slightly lower, though still positive 3.48%. And the fixed income market did drop, as you know. The yields have risen and now have come down a little bit, but we did break into the 160s, near 170 at one point. So as yields rise, the price of bonds drops. So we did see a very small loss in the fixed income side. So, and that comes off some very strong fixed income numbers just 6-9 months earlier, as you know, as the pandemic started to take hold. There was a flight to safety, and we saw, double-digit returns on the fixed income funds. And as we expected, this would start to unwind itself. So we've seen that a little bit. But all in all, it's been a really good quarter for the markets. It's been a good quarter for the plan, for the performance in the plan. So with that, why don't I hand it off to Bob? We can go through the asset allocation. We can share the performance. And of course, if you have any questions, please feel free to ask.
Thanks, Bob.
Bob?
Yep. Good afternoon, everyone. So I'm going to start on page 5. And if I go too fast, let me know. I'll give you a couple of seconds. But the top left is going to show us the overall asset allocation. So our equities are at 68.4 versus the target. So we are quite overweight in equities. And part of that, most of it, was we had a return of over 18% in equities last year. And if you look just over the last 12 months, the equities are up 56%. So haven't had a lot of time to rebalance, especially with the way interest rates are moving. And we still continue to believe equities are a better value than fixed income. And I always keep some cash on hand just in case we have a buying opportunity or if there's something with payments that needs to go out. So you can see we're at 26 versus 40 on the fixed income. And then alternatives, which just is a brand new preferred security I bought last year. It's just a preferred stock security. All that does is generate more yield than the overall fixed income. Like Bob said, the 10-year treasury is at about 1.5. The preferred security fund pays a little over 5%, but the maturity is much longer and not as high quality credit. But if you go to the bottom right-hand side, you can see where the account started. That's the third number down. It includes accrued income. So we had a little over 33,000. And then after the contributions, withdrawals, fees, and income, and market appreciation, we ended up with 34,374,000 for a 2.55% return. And I looked last night, and the account has broken $35,300. So
35 million.
I'm sorry, 35 million. Yeah, that's better. And the market, even the growth and value are really catching up to each other. Value had a big range this year. Value is up 10% versus growth of 1% just in the first 3 months. But if you look out last year, growth, which is primarily consumer services, discretionary, and most predominantly technology, they did 40% versus 0.2% for value. So the Fidelity Contra Fund, which I'm going to show you on the next page, oh, not the next page, in 2 pages, but we've been predominantly overweight growth, and it really paid off in 2020. And we continue to show you that it will.
And
But this is the chart. Oh, you can ask any questions.
I don't, at this point, I seem to be missing an email would have your report and the minutes and perhaps the agenda. I've got stuff from Amy about if somebody could forward that to me, that'd be great. Please.
Sure, I'll pause if anybody wants to send it to her.
Jason, if you want to give me the ability to screen share, I can share his report that he's going through too.
There you go, Alan, you're all set.
Just let me know when you're ready.
I think, Bob, you can go ahead. I can catch up, but I don't have them to share with my folks, so.
Did any of the other members have any page on that first asset allocation page at all? Great. The next page, which is page 6, yes. Which is page 6. This was the new report we added a couple of quarters ago, but it shows you the different asset allocation movements in the portfolio over a rolling 4-month quarter. And if you can take a look just at the top line, it's the easiest way to see this. So Q2 2020, which is the first box, you can see the total market value in the large cap, they're up over $15 million. And then that was after a 20% quarter. And then after a 12% quarter, or a 9% quarter, I'm sorry, in Q3 of 2020, you can see we approached 17 million. And I won't read all the numbers, but by the time we got to the end of Q2 2021, we had a little over $20 million in large cap. And then it breaks it down by the sub-asset classes. And I'll just point out a couple here. But you can see if you go to small caps, at one point in Q2 2020, we had around 3% in small caps. We were under the impression that the economy wasn't going to take off. We had a huge recovery from the largest recession since the Great Depression. And we thought it was just going to take a little steam out of the US market until we got the answers to the COVID vaccine, the election, fiscal stimulus, and whether or not monetary policy was going to stay accommodative. And of course, I sold it, trimmed it, and it took off. So small caps beat large caps last year, but I think they're overvalued right now for large caps. And then you can just see the other numbers, particularly the high yield, which is a purple one. It's the third from the bottom. High yield has a large correlation to to equity markets in general. It's probably about 70 to 80 basis points or correlation. So it moves in tandem with the equity markets. And again, we thought the equity markets were a little frothy, and I just wanted to take some off the table. We'll be adding back to that on any sort of a pullback in the market. And then you can just see the last two. It's just alternatives and cash. Any questions? Does it all make sense? Okay. Page 7 will just show you our show you our holdings, which I'll go through more in detail in a couple of pages. But all the same usual suspects. Like I said, no new names, just some different weightings. So if you go to page, give me a second, sorry about that. Page 10 will show you overall performance, not just for the quarter, but the 1, 3, 5, and inception. So 3 months is such a short period. Let's just break down the 1-year number because you don't get to see numbers like this much. Total portfolio was up 34. Even after fees, it was at 33.5. And then, like I said, if you go a couple lines down, our domestic equities were up 56.87, while the S&P was up 56.35. And to Bob's point, international is doing very well, just like last year, 46.73, and then our fixed income did 3%. So it was a very good year overall. And then you can see, even on the 3 and 5 on the total portfolio, even after net of fees, we're still double-digit returns that have to be a lot better than the actuarial assumptions. And then even since inception, we're up over 9. So the numbers look really good to us. Hoping they look good to you guys as well. Any questions on any of the numbers? Okay. Page 11 will show you the year-to-date, it's called the detailed asset analysis portfolio. Well, what it does is just show you what each asset did and how it returned and whether or not I added or subtracted to it. So the top fund, let's do that for an example, the Fidelity Contra Fund. You can see in the net flows line, which is the second one in, I added $1.1 million to that in the first quarter. Again, we're under the belief that interest rates are going to stay low, which is great for tech stocks. We don't think the economy is going to open as fast as everybody else does. So again, this manager has a lot of tech consumer discretionary, so he should benefit from a slower opening economy. We've had this mid-cap fund, the small cap fund, but what I really wanted to show you was on page 12. I talked to you about the fixed income. When we first started back in 2012, we had decided to basically make this an individual stock portfolio and just tried to do a ladder. But little did we know then, the 10-year treasury would go from around a 4.5 to 0.38. And it'd be impossible to get some yield on an individual bond. So you can see assets sold during the period. We had 800,000 of individual stocks come out of the portfolio, which was about 10% overall fixed income. So that was a large chunk. And at the time, we thought interest rates might have spiked. And to Bob's point, when interest rates go up, prices go down. So you don't want to lose. So I'm just looking for a better entry point for put some of that cash to work as well. But so that's what's happened in this portfolio in the last quarter. Nothing drastic. We're still sticking to the plan, anywhere from 60 to 70 on equities. We are a little under on fixed income, and that's because of the huge roll-off of the individual bonds. But anything less than 3 months really doesn't shock me on an investment policy statement. I mean, day one, it doesn't have to be corrected. You usually get a little bit of time to fix things, and especially not force yourself into buying assets that you don't think are valuable at the time. If nobody has any questions, we can go to the OPEB.
I'm just curious, actually, what you think interest rates are going to do over the next, 6 to 12 months, or really even inflation, if you see that being a factor.
Yeah, I mean, we don't see inflation spiking. I wouldn't be surprised if it hovered around 2 for the next 6 to 8 months. And interest rates, it's at a 1.53 right now. I think it's going to be anywhere between, and I know this is a broad range, but we're assuming anywhere from 1.5 to 2.15. And even at those levels, it's historically low. And even if you buy a 10-year treasury at 2.15 and you're getting inflation of 2%, you're getting a 0.15 overall for 10 years. So it's still really not attractive. But that would be our long-term guess, 6 to 8 months.
Yep.
Is that okay?
Yep. Thanks.
Yep. The OPEB, again, we'll just go through the same format. We're a little bit lighter in equities. We have 65%, about the same in fixed, about the same in cash, and a little bit more in alternatives, just 1%. But the bottom right, you can see where we started, where we ended. I won't read all the numbers here, but we made basically close to $80,000 for the quarter, up 2.82%. Really, the only thing that's different in this portfolio, which is on page 16, is I do have a little value in here. When we started this account, growth had been on tear for years. Growth has outperformed value for 10 to 12 years now. And I just thought, I think this was about 6 years ago we opened this, or 5. I just thought it might be a good idea to just have a little chunk of value, and that's the JP Morgan Equity Fund, the second one down. Other than that, these are pretty matching. We can go to, yeah, it started almost 6 years ago. Page 19. And it's almost duplicate returns, except we don't have double digits right on the line for the 5-year. But you can see 35.79 for the 1 year, and then over 10 for 3, almost 9 for inception. Any questions on that? And I don't have to bore you with the net flows on the other assets because I really didn't do much in the quarter. I really positioning, so I didn't make any changes. So we don't have to go through that. The only other thing I brought for you for my presentation, I just brought the Morningstar sheets. I like to leave those behind if people want to go through them and ask why I'm holding a certain fund. I'm always happy to answer questions afterwards or at the next meeting. So I brought those as well. But if no one has any questions for me, I'm more than happy to give it back to the chair of the committee, or do we go back to Bob LeBrew?
Yeah, thanks, Bob. I'll just to wrap it up. You know, we're pretty bullish on the rest of 2021. We think the second half is going to be pretty good, which is pretty much consensus. So from a positioning standpoint, from an asset allocation positioning standpoint, we're going to overweight equities versus fixed income. You see that now. We're pretty close to the top end of the band. We expect to continue that. Within the equity component of the portfolio, it's going to be predominantly large cap, U.S. large cap, and we'll continue to have representation in both the mid and the small. So I would say 85% would be U.S. large cap. We believe that that's where the alpha will come from. And of course, we'll maintain our position in international. And I know I've said this before, the valuations look a little bit better, but you know, there always seems to be some issues. We're excited about those prices and would like to increase our weighting there, but you know, we're waiting for the opportune time. So basically, overweight equities, underweight fixed income. We'll deploy a little bit of the cash. As Bob mentioned, it's a little higher than we've been in the past. We usually run around 3%. That covers our benefit payments and any other expenses that come along the way from actuary, our fees, so forth. But we had the contribution come in. I want to say it was sometime mid-February. Plus, we had a couple bonds mature, and there were a couple bonds that were called. So we had a lot of cash actually within 15 days of March 31. So, and we'll put that to work. But we're, again, just it looks like it's set up pretty well. Of course, we get our eyes on everything. Things change, as you know, so we're on it. There'll be checkpoints along the way. Right now, the focus is earnings. And so far, earnings have been pretty good. But you can see that the market really hasn't moved that much, even after really good earnings, because a lot of this is kind of built in, and you're going along a route, and you believe things will be better as we do towards the end of the year. But, you know, you want to make sure that, yes, those earnings are there, come in. So there'd be a lot of focus on the infrastructure bill, you know, and when those funds will be released and so forth to continue the momentum that we've seen really that kicked up last summer. Got a jump start when the vaccine was announced in November. We had a little rotation, as Bob mentioned, you know, out of value or actually into value from growth, but that seems to be somewhat short-lived. And we're just a growth believer. So So really what you see now is pretty much the positioning we're going to maintain, and we'll continue to watch earnings. We'll continue to watch developments as far as the infrastructure bill and so forth. So unless anyone has any questions about that, I think we'll turn it back over to the chair. And I know we're going to talk about the IPS statement, so I'll wait until you're ready to do that.
All right, thanks, guys. Anybody got any questions or comments that they'd like to make? I'm trying to hold on, my Outlook is, excuse me, my Adobe is clocking. Almost there. Go. All right, I don't know if you guys want to just jump right into the IPS, if we want to move that so they can, while they're here, discuss that, and then we can move on with the rest of our agenda, or if you want to just continue down the route that we're going.
I think taking it down.
Yeah.
Makes sense.
But I entertain a motion to take up old business 6B at this time.
So moved.
Second,
Any discussion? All those in favor?
aye.
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 Aye. So moved. Okay, guys, take it away.
All right. Well, looks like a great job. You know, it's important that periodically we review the investment policy statement to make sure it's in line with our goals. As you know, the landscape changes, expected rates of returns change, actuarial assumptions change. So it's always a good idea to, you know, review the policy and make sure that, you know, we're on track with where we want to be from an investment perspective. So this, I mean, we're happy with the way this is. I had just a couple of comments. I know George had the opportunity to review this, so we appreciate all the input that he put in there. When I go to, you know, specifically, if I can get this to move. Oh, there's no page numbers on there. Okay. It's page 2 on my document. And I'm not looking at the red line copy because that's a little tough to follow. I'm going right to what we're proposing to be the final. So on page 2, there's a section B. It talks about the portfolio manager's role. So what we have there is this little bold insert that needs to be removed. Apparently it was put there, you know, as an example of what language would be typically included for the portfolio manager's role. So we would have to remove that section there, of course. I'm sure you can see that. And while I'm in that section, we haven't typically, because we're a discretionary investment manager, we haven't typically provided our due diligence on the managers. But what we do provide you each quarter that we meet is the Morningstar fund fact sheets. And those fact sheets have the information that we use to analyze how well a manager's doing within their peer group and against an index. So it gives you not only performance detail, it gives you information about the fees that those funds charge. It gives you other portfolio statistics like alpha, beta, standard deviation, R squared, those sort of statistics that we look at to make sure that they fit within the portfolio and the guidelines set forth in the IPS statement. So we'll continue to provide those. So I'm going to just generalize and say that that would be the information you'd get from us. Nothing new, but it is very detailed, as you know. I would suggest, and we don't have to do this, again, it's something we've always done, that the portfolio or the IPS statement include language that says the portfolio manager will provide a periodic performance summary on the total portfolio. So that's, you know, backing up a little bit and saying, okay, we know how the managers have done based on the Morningstar sheets, but how, based on asset allocation, how did the overall portfolio do? And we don't mention that here. Not necessary. Certainly would defer to George on that, but I just know it's something that we've always provided you, and we just went through it, and I know it's of great interest. How well did the portfolio do, not just the underlying managers. So other than that,
So Bob,
yeah, Amy, how are
it's
you?
Amy. Good. So are you thinking instead of it be prepared, delivered to the board, or at least semi-annually written report summarizing its review, research, and analysis described above would be removed?
I'm suggesting maybe we consider modifying it slightly. And I understand where George was going with it because, we're using mutual fund managers. So we wanted to bring something to the table to show the committee, how well those underlying managers did. And obviously we're going to do that through the Morningstar sheet. But our primary performance reporting, or what we bring to the board, is the reports we just showed you about the asset allocation and the performance of the portfolio in total.
So what was your wording? I actually liked your wording.
No, I can send it to you when I get back.
Okay.
I'd be more than happy to write something up. Yeah. So that way we're doing both, and that's what we should be doing. We've all, as you know, we've always provided both to you since the inception, going back to 2012, I want to say. So, yeah, it would be just a thought to add that. I'd be more than happy to. I'm in Florida this week, but I'll be back and I can shoot couple of bullet points, and we can make sure that George is good with those, and if so, then I think we're good. Now, I did have one other thing. Are you all set, Amy? You want me to?
Nope, that's good.
Okay. All righty. So where was it? There was a good comment from George, because it does get confusing a little bit. So I put some rails on when I was working with this. And so I had this thing, international equities. Let's see. I don't have page numbers. I wish I did.
That's the
So
fourth
it's in
page.
this. Yeah, it's in the section just under the asset allocation. So what we're doing here is says international equity should not represent more than 25% of the total equity allocation in the portfolio. So, but it gets a little confusing because just above, I had a different overall max target. And that's because the chart above, where it breaks a little bit more granular than we had before. We broke it down between large, mid, small, international developed, international emerging. We didn't have that before. And I have a minimum, I have a target, and a max. So it didn't seem like it lined up quite correctly. And the reason is that these max, min targets are all of the total portfolio, where the second section in each equity and fixed income place some limits within just the equity or fixed income component. And the reason I did that was because if we were, say, at the minimum of the total, let's say for equities, we decided we're not going to be close to 70, we're going to be 50. Well, I didn't want to be at the minimum overall for equity, but be at the maximum, let's say, for international developed or small cap, because now small cap would represent a much larger percentage of the total allocation at that point. So I wanted to have a little guidelines there. It's very common to have that. So that way we don't, make sure that 40% of the portfolio is in international, because we're at the low end of the band overall. So that kind of just makes sure that we're not concentrated, if you will, in one asset class too heavily, because we've made a allocation decision overall to be either at the low end or the high end. So that's why that percentage is different than the one above. Does
Which
that make sense to
appears to
everyone?
be fine, right?
Yeah,
So you can do 25% of the equity.
Correct.
Okay.
Correct.
So we just need to ignore George's comments.
Yeah, I just wanted, well, I wanted to address it. I don't want to ignore anything he has. So I know he worked on this hard and he did a really nice job for us. So, but yeah, it's just a clarification. That's all. That's what I'm doing there. Other than that, I don't think there really was many changes. I think it looks pretty good. I mean, the overall purpose of this one was, we should review it, of course, right? And the other was I wanted to be a little more granular. It was a little kind of basic, if you will. It served its purpose. It served us well. But I think that, putting the total portfolio asset allocation and minimum target and maximum, it's a little clarity. So that way, when you're looking at the portfolio, it's a little easier for you to say as a board, yeah, we're in compliance, which is one of the duties, of course. Just trying to make it easier for you. Other than that, I think we're in good shape.
I have a question. If this report it's going to come out quarterly, you said?
Yeah.
Well, this is the one you're seeing now.
Okay. And I could be way off here, but if we're going to score our performance, which is basically what we're talking about here, don't we need to score it up against something?
Yeah, it's at the bottom. It's at the bottom of the IPS, and you're already doing it in your current portfolio.
Okay.
So
Yeah.
no, but
Is
Ed, really,
this Ed?
Yeah.
if you go on page 10, and sorry, Bob, I didn't mean to interrupt.
No, go ahead. You
But
got
I can finally interject. Just teasing. There's a foot at the bottom of the page. You can see that's the blended benchmark we compare it to. So right now it's pretty basic. 40% intermediate U.S. government credit, 55% S&P, and then only 5% in MSCI EAFE. So what we've pointed out before, if we're investing in mid-cap, small-cap, emerging markets, it could hurt us versus the blended benchmark. Now we're putting those asset classes in there.
Okay.
Yeah. So yeah, Ed, we've that we give you the performance for the portfolio, and then there's a total blended benchmark performance. So and that is incorporated. So that's how you keep track of how well the portfolio, or how well we did with the portfolio, over the longer term, of course. So
I was just trying to be the average guy that pulls this information out, that thinks he knows everything and says, okay, so you guys did 17, whatever that number means. Well, what did the rest of the world do? And if we could sit there and say, well, our benchmark was at 16 and we outperformed it. And I'm just making those numbers up just because whatever.
Right.
I just think I can hear somebody coming back and saying, well, what does it compare to?
Right. Yeah. Always should have a blended benchmark, in the policy. We've always had it. We have it now. It's on the last page of this proposed policy changes. It is changed slightly because it incorporates some of the other sub-asset classes. Ours was pretty generic in the past. Here, the point is that we believe that multiple asset classes are appropriate for diversification purposes. So we should be using them, and we always have. We always have used them, and they've never been in the benchmark. So what that meant was that we were tactically using mid-cap and small-cap. So, and we just want to make sure that the policy embraces that diversified blended benchmark as well. So it's pretty standard in what's used in a pension plan. So we don't want to be out of benchmark so much, and that's kind of where we were. Even though it was permitted, of course, we could use it. It was not part of the benchmark, so it was really a tactical move. And I don't think small cap, mid cap, emerging markets, those aren't tactical allocations. Those are allocations that a well-diversified or globally diversified portfolio should have. So, make sense?
Yep, I'm good.
So the only other comment I'll make is you guys had asked in October if we could just add OPEB into this, and George said no. George said we really
Yeah,
need an
so
OPEB policy. So do you
That's
guys have
okay.
an OPEB
Yeah.
policy you can send our way?
yeah, I'm going to give it a crack, and that's fine. That's okay. You know, I just have to have a conversation with you, Amy, about the actuarial assumption, and then we can kind of work around that because we know that's kind of the basics. You know, we're looking for an investment objective. You know, what kind of return are we looking to get here? So, and that helps drive. And then, yeah, I have some stuff that I can share. So I owe you some bullet points for this one on what we'll provide, and we'll throw you a draft of the OPEB.
Perfect. Thank you.
Yeah, you're welcome.
Do we have any other questions or comments that we'd like to make?
Thanks for your time. I appreciate it.
Well, thank
you're
you.
welcome.
Hope everyone's doing well. Looking forward to summer.
Yeah.
All right, well. if that's
Post-COVID
it-
summer.
Yeah, COVID-free summer? Yeah.
Yeah, post-COVID summer, right.
Get your vaccines.
Yeah, I got my 2, so I'm good to go. Good. All right.
All right,
Well, I'll stay on. I know Bert was going to do something on the 403B, or I mean, you guys can shut me down. Whoever has the control panel there, it's up to you. So I'll hand it back over unless there's any other questions that you have about the IPS or the plan.
You're welcome to stay.
This guy's in Florida. That would be a foolish move to volunteer to go to a when you can be sitting on a veranda looking out on the ocean with a nice adult beverage.
Oh, yeah, but they're all in the kitchen right now. So if I walked out there, what do you think would happen?
All right, so the agenda says approval, but it looks like a couple of edits we'd want to make, so we want to hold this approval for now and just go with that. All right, okay. So thanks, and I'll entertain a motion to go back into regular order.
So before you do that, we should postpone action on that till the next meeting, just to flag it as something that's being included.
Gotcha. So yeah, I'll entertain a motion to postpone action on item, 6B, business approval of the pension benefit investment policy statement.
So moved.
I'll second.
Okay, all in favor?
Aye.
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 Here we go. And I'll entertain a motion to go back into regular order.
So moved.
Second.
Favor?
Aye.
Aye.
Okay. So we have 5B, 401 and 457B, investment analysis.
And that was Bert from
Yeah,
Worcester
can you
Bay.
guys hear me?
Yep,
Yep.
Can I start to talk or is anything else that should be said?
go for it.
Okay. So just in hearing everything that Bob was going through in that last section, I had sent over 2 attachments. One was an investment review, and another document was an investment policy statement, which you guys were just looking at there. And so George is who? George, who was reviewing that investment policy statement, was who?
Our pension
Yeah.
lawyer?
Okay, so would he, would he be reviewing this investment policy statement also? Or is that
Yes.
separate?
No, he would,
Okay,
he would also do that.
Okay, so just for the purposes of the meeting today, so I was selected to be the 321 investment advisor to the plan back in October. And so I just wanted to, as soon as I can, just get in front of everyone and sort of take the next steps. And the next step would really to set up an investment policy statement for the plan. Again, my role is different from Bob and Bob in that we're not looking to make tactical allocation things. All we're doing is monitoring the investment options offered in the two plans, 401A and the 457B plan. And so the document, sort of goes through this. It's sort of a standard document that we use, but it's certainly, there may be some language, and I left a piece in there just to sort of show that we wanted to. If you looked at the investment policy statement, Alan, I don't know if you want to bring that up for everyone, but if everyone has access to it, right on the first page, it says, the plan is subject to ERISA. It is not. That's sort of boilerplate language that we have in there for retirement plans that we're acting as the fiduciary on. And so something like that would be struck out. But as we go through the rest, it just sort of highlights some basic things in terms of who else on the board. I know when I signed the contract with the town, I think Amy, that's the other one that we'll go through second. Amy, Jason, and one other person who I can't recall right now had signed it, but I don't know if everyone on this call would be considered to would be signing on as part of the investment committee, and hence, and therefore signing the investment policy statement. Is your sense that everyone would?
No, it would be probably David as the chair, and then Jason as administrator, and me as an administrator.
Okay. And so, again, you can, I had shared this previously, you all may have seen it. It has certain criteria that we're going to look at, and, talks, if you go to page 2, it talks about the objectives of it, what we're trying to do, what the fiduciary's responsibilities are. One of the big pieces here, and sort of differentiating between what the two Bobs are doing and what I'm doing, he clearly said that they're acting as in discretionary. They're, looking to move money here or there, and they're not coming in front of the board for that. Here, any changes that would occur on the two plans specific to the investment options would be, I don't have discretion over. It would be after discussions with everyone here. And so there's going to be criteria set up, but there's also the flexibility that we're going to have discussions on how this is done. Again, I'm not going to go through every line. It sounds like that's something that George will do. And then the next time we have a call, it be something that, we will have gone through everything cleanly and can make sort of decisions as to what needs to be amended or kept, and so on and so forth. Page 5 of the document, if you're sort of going through it, is where the people would be signing it, who would be on the actual committee. Appendix A just talks about the asset classes that you're typically looking at in retirement plans. Again, different from what the two Bobs are doing. More importantly, Appendix B, which is page 9, it goes through our scoreboard process. Essentially, we have a 12-point criteria that we're looking at these funds in performance. And again, I'm not going to go through, detail, but, essentially, there are 2 points given for investment style. It's going to look at style consistency, Sharpe ratio. For the purposes of this call, we don't want to really go through that. There's going to be 2 more points for, or 2 more. Then it starts to look at risk measures, where there are 4 points scored, 2 for beta, which is essentially volatility. And we're looking at 3 and 5 year. Also going to look at, we call information ratio. It's very similar to some of the things that Bob and Bob were talking about. 2 points for that, looking at 3 and 5 year. Then we're going to look at performance relative to the index, to the peers for 1, 3, and 5. And then what we call up-down ratio, meaning we like to have funds where, Bob might be looking for funds that are sort of maximizing this. We're looking at these investments as not being tactical, but longer term. And so we're concerned about the upside, but also more how they've performed on the downside. And so, again, if we're looking at that upside and downside capture, and that's one point. And then the final 2 points, and again, you're not going to be tested on this. We're going to just look at expense ratio, the cost of those funds relative to their peers, and manager tenure. So if we're making sure that we're looking at the performance of that actual manager. And so those are the criteria that we look at. Alan, if you pull up that other the document that you showed initially, I'll just go through that fairly quickly.
Okay.
Just to bring the scenario in page appendix C in the investment policy statement just goes over the selection process. You've already done that. I'm not going to do that already. Then and it also just talks about the investment monitoring. And this, if we look at the actual performance of your investment options in the 401A or 57 plan, sort of give a little bit of a hint of that. And so if people who have been able to see me on the screen, you may have noticed I'm in a car. I have to hop into another meeting after this. And so I can't see everything as well. And so if you're on page 3 of 13, is that what that's showing right there, Alan?
Yeah. Yep.
Okay. And so you'll see it's fairly easy to look at the scoring system. Anything that is scoring more than half of the 12 points, 7 or above, is going to be in greens, and that will be the equivalent of a passing score. Anything 6 or below is not passing, and you'll see that it's in red. So pretty easy to look at. I think if you're on page 3, you'll notice the 2 funds that are not passing right now, the Prime Cap, Odyssey Growth, and it hasn't been passing for the last, I think, 7 consecutive quarters, and the small cap value, LSV small cap value, currently scoring a 5, Odyssey Growth not currently scoring a 6. And again, why we want to be not discretionary. If you flip to page 6 of 13.
It's clocking. I'm getting there.
Okay, no problem. Take your time. And essentially what this does is sort of take a little bit of a deeper dive, and similar to what Bob was saying, we can get into much deeper detail than this, but it gives a pretty good overview. And what this is showing, and if someone can see the screen well, if you looked in large growth, if you can see Prime Cap, Odyssey Growth listed. And when you go across that, you're going to see numbers in parentheses. So when you see that 20, that's the percentile rank. And so that means it's in the top 20 percentile. So the lower the number, the better the position. If you look at the next piece, it's in the 98th percentile. And so essentially, that's, if you start to look at the longer performance numbers, that's why it hasn't performed as well. And almost to what I think one of the Bobs were saying is that large cap growth is a very fickle, in my mind, category. If you're heavy tech, you did outstanding. The first quarter of this year, you actually, in probably the last 6 months, there's been a little bit of a tilt towards value. So you'll actually see this fund has actually performed extremely well, especially extremely well year to date, up 11% versus its peers, which is up about 2%, and the other option in that category being up 2.5%. And so the reason, and this is a fund that hasn't performed well over the last 7 quarters. And so we don't want to be too quick to judge. And, that's how we're going to look at these things. It's going to be specific scoring that you're going to be able to look at. We're going to be looking at performance. When we see a fund that's underperforming, we'll really take a deeper dive. And my hesitancy is sometimes you don't want to throw the baby out with the bathwater. You want to be a little bit more patient. And you'll see sometimes, unlike, the Bobs, people might not have big allocations to this. If you flip quickly, and this is just going to be my last point, on each of 7 of 13, it's the similar story with the LSV small cap value. And Alan, if you can say if you have flipped that, I can't tell.
It's locking, it's getting there. There we
Okay,
are.
perfect. And so if you'll see this fund, it's, and again, we're looking at numbers that are coming from where we had a low on March 24th of 2020. And so this is effective April 1st of 2020 to March 31st of 2021. And so you couldn't have a better period. And so you're looking at a fund that was up 105% over the best last 12 months. It's not a good snapshot, but again, you'll see this fund is in the 35th percentile year to date. It's also up 23%. And so that asset category has done very well, but it's even outperformed its peers too. And so similarly, it's been in a time period when a pure or that asset category has performed very well, and that this fund is sort of done very well. And so, you almost can take away if it was pure to its strategy, it really is when it's shined. And so, again, we want to take a long-term approach to these and sort of not make changes as rapidly as maybe you might be doing on the defined benefit plan. Does that make sense for everyone?
Bert, this is Amy. So I've done this before in my previous job, but
Yep.
The watch or something was going on watch, would it be a different color in these last two pages? Or would it be previous to that I would have seen? Because
No, and so-
obviously we switched to these in 19. I think we opened our ICMA in May of 19. So we would have switched to this first quarter of 19, which
Yeah.
those numbers were good then.
Yeah,
It's been
exactly.
since then that they haven't been.
And that's why I try to preach patience, because sometimes it isn't like these people just got dumb. It's just cyclical, and especially in the small cap value, that it was not doing well, and that underperformance, if they're pure to their strategy, not trying to boost returns by being, including more growthy things. And the same thing with the other fund. If it's pure to their, just going to their long-term strategy, the Prime Cap Odyssey has been around forever. But yeah, if it's in red, that means it's on a watch list. If it's 4 consecutive quarters, we typically want to note it. It doesn't mean that we're going to remove it, but if you look at, and Alan, you don't need to do this immediately, but if you scroll to the last page, 13 of 13, that's where my notes will go. And that's the notes that I share typically with my clients. If we want to do, obviously this is a town format, and so if it needs to be done in meeting notes, but that's typically where I share notes with my client and just say, large, Odyssey Prime, Vanguard Odyssey Prime Cap is underperforming, but for these reasons, we're going to keep that fund despite being beyond those 4 quarters of underperformance. Same thing with the LSV small cap value. We'll just note it and go from there. Does that make sense?
So these notes would be something you would provide after our meeting?
Yes. And typically based with answers, a lot of my clients, I'm doing more than this. We're looking at where the participants' balances are and so on and so forth. This will be fairly straightforward. It's just purely looking at the investment policy statement, the performance of the funds, and then providing you notes based on that.
I think I have the access in ICMA. If I wanted to see who was in these and what kind of dollars were in there, we could do that.
Yeah, and so at some point, if it makes sense, I think it does. I do have access to the plan. The worry is that there are about 40 participants. It looks like maybe have all their money in sort of a capital preservation. And again, we're not providing education to the participants, but we might want to look at the reality as to why that's happening, because my feeling is some of those participants, if they have a pension plan, they don't need to be stocking money in a 457 plan into a fixed account. But again,
so I'll share a little history for you. When we switched over to ICMA in the old Voya plan, we had a 4% fixed. that
Okay.
then they switched to 3% fixed, but we rolled people's to like investments.
Okay, so it was a mapping
So
strategy.
the ones that have the fixed really want the fixed.
Yep,
So-
yep, no, I'm fine with that. And I'm just, and again, but that's typically the types of things that we're looking at with these
And
notes.
they all do have pensions.
Yeah, and that's fine, that's fine. If they're depending, it's 40 people, if they had money in fixed, they may be in their 50s, 60s, 70s. And, or, you know, that's an appropriate strategy or a comfortable strategy for them.
So that's why we have so much in fixed, but that's their own personal choice. So
And it's relatively not, it's a bigger number than I'd like to see typically, but it's not 50%. It's like, it was like 1 million plus out of 8 million. And so I wasn't too concerned about it, but it's, again, the other types of things that we tend to look at. But meaning this page will be fairly straightforward.
all right.
So I'll
Thank
share
you. That was very helpful.
I'll share that with everyone, and then I think, you know, I'd like to be on the schedule. I think the goal was maybe twice a year, but I'd like to be on the schedule for the next meeting too. After George has a chance to look at that, and then I'll share his notes with everyone in advance, and really hopefully have a close to a finished product in that, because then once we have that set up, then, you know, if we need to make changes, you know, you have the document that says this is our process and we're following that process. Right now, we don't, I have a process that's been discussed, but hasn't really been approved.
So this group has never chosen investments. So when you came for a replacement for one of those two that are on watch right now, would you bring us like 3 choices of similar type investments?
Exactly.
Perfect.
Exactly. And we take a little bit of a deeper dive. And again, it isn't the rules on this. It's fairly lenient. You're just trying to make the best decision. You've never been sued for not picking the best funds. You're not picking. People are getting sued on the private sector more than the public sector, but by not having a process and not following it. Does that make sense?
Perfect.
Okay. I really sort of have to run right now, and so I don't mean to be rude, but I think I sort of threw a lot out there, but it's not anything that we can really act on. And so that's all I pretty much got.
Thank you very much, Bert.
Okay. Have a nice night, guys. And same as Bob, I'm getting my second shot on Monday, and hopefully next time we can do this potentially in person. Have a great week, and I'll talk to you guys soon.
Take it
Thanks
easy.
for the help.
Okay, so next up, 5C, approval of tentative agreement with AFS CME Council 4, Local 3583.
All right. Well, Bob LeBrew is going to drop off. So everyone have a great night. And Amy, I'll get that information over to you next week.
Thanks, Bob.
Perfect. Thank you. Enjoy Florida.
Well, thanks again. Bye-bye now.
Okay, so. I'm trying to find that document myself, actually.
While we're
I'm
waiting,
looking
could
for it. Just give
somebody,
me 1 second. I'm distracted at the moment.
Our future first selectman.
I don't know if I have a,
It's part of my original package, Alan.
yeah, I'm going back through your emails actually, and
I sent it the Friday the 9th, April 9th, before I went on vacation.
yeah, I have something from you on the 6th and something from you on the 16th, but I don't have anything in between.
I have it from Josh on the 6th.
I don't have it from Josh on the 6th either. Wait a minute, maybe I do. Hold on, I got a filter on. rough. Out of here.
Jay has it up on the screen, Alan.
Oh, okay. All right, well, this was a long time ago that we actually did this. It seems like forever ago. It seems like this was like more than a year ago. Here we are.
10 years ago.
2018 was already done before I started.
And then, yeah, we got it finished up and then it got kicked around. Took a long time to get ratified, I think, is what the problem was.
Yeah, and we're gonna need to do, the pension board is going to need to approve this, and then the board of selectmen is gonna need to approve it.
So basically, do we want to just go over what the few changes are?
Yeah, it's funny. I keep on trying to control this screen.
Sorry, I'll drive.
I'm trying to remember what the sticking points were, but I think in the end there really wasn't many, but except for how much, like 1D, right? Jason, if I remember correctly, that.
Yes.
Yep.
1D, we ended up doing an additional 0.5% on the DB portion of everybody's plan. So it didn't just impact the DC people. We had originally, we're going to increase the DC contribution, but they opted to do the DB instead. So the old plan people previous to the hybrid are now at 7.5. And the hybrid people are now at 4.5. So they both went up 0.5.
It's ended up being a pretty good deal for the town. I think fair for everybody.
And the vesting was a police request, wanting their new hires to have 10 years instead of 5.
What does Josh always say? Eat their own.
And then the normal retirement date, we switched this to be consistent with everybody else. Now it's the first of the month after your birthday, instead of got rid of the January date. And we've done this on every plan as we've gotten to them. It just makes more sense. I think that's it.
Yeah, I think that's right.
So yeah, I think this turned out pretty well for the town. I don't know if anybody's got any other questions, or if otherwise I'd entertain a motion to approve.
I move we approve the tentative agreement as submitted.
I'll second.
Any further discussion? Seeing none, all in favor?
Aye.
Unanimous? All right, and next up, we have approval, new business 5D, approval of a defined benefit plan, appendix B1. Jason, do you have that available? Because I don't think I have those two either.
I do. Just give me 2 seconds to pull it up.
Yeah, sorry.
So the difference between B1 and B2 is B1 is tied to the people who just have a DB plan. B2 is for the people who have a hybrid plan.
So, and these are just the specifics of that plan for each side, so.
Yes, this would be the appendix attached to the pension plan doc that we spoke to a lot. I think we approved it in 2019, but this would be the appendix specific to the bargaining unit prior to 2007 hires. And then the other one would be people hired after 2007. But this shows the that they're contributing 7.5% in section 1. That it's the first of the month following the retirement age. Let's see what else they have. The 2.25 multiplier didn't change.
That's a
Average
very
earnings.
general multiplier.
Average earnings did not change. None of the disability stuff changed. And the vesting is tied to a section in the actual plan doc. And that's it.
Anybody got any questions on this one? Seeing none, I'd entertain a motion to approve this one. Appendix B1.
We approve the defined benefit plan Appendix B1 as submitted.
I'll second.
Any discussion? All in favor?
Aye.
Aye.
That's unanimous. Thanks. And then we have 5E, approval of a defined benefit plan B2, which, as Amy explained, is the newer folks.
So this has the change in one about the 4.5% they're contributing. The retirement age is the same thing. It's the first of the month following the date they reach age 60 or 25 years of service. Their multiplier is only 1.25% because they also have a DC part of their plan, and it only goes to 1.5 after 20 years of service. And let's see, average earnings stayed the same, disability stayed the same. And then the vesting is where it's different. It's 5 or more years prior to 2007. And then as of the date, it would become vested under the 10 years.
Why did they do that? Why did they want to do that?
They're trying to keep their officers longer.
Yeah, it's a retention tool.
So there was no skin in the game if they were all done in 5 years. So in 5 years, they get fully trained by us. We send them through the academy, they get onto the force, and then they switch to somebody who has a full DB.
Right.
So we've paid the cost of all the training. Well, you pay their salary while they're in the academy, and then they take that training and go somewhere else where they can get a full DB. So they've asked for it to try to keep the people who are coming in, to have them have a requirement of 10 years.
Amy, was the most recent retiree effective this week on the hybrid or the straight DB?
He was a hybrid.
Okay, so that, in that case.
He had
was
12
with us-
years of service.
He was with us for 12 years, so that shows that the retention effort, well, doesn't show that it worked, but it certainly suggests that it did.
So he's the first retiree on the hybrid part. And we had a few bumps in the road with Milliman. They didn't realize we had 2 different buckets of people and gave him twice as much retirement benefit as he should have gotten in his calculation.
Whoops.
Yep. So we have checks and balances in place where we check the most recent statement from Milliman to make sure the calculation is somewhere close. So we caught it and we're able to get it fixed before he was signed on and collecting pension payments.
That was close.
It's hard. There's a lot of nuances, and as you spread across all these different appendix and the different bodies of people, and the farther we get from it, where we now have some people in clerical that are just DC, it's hard to keep it all straight. So there's a lot to be done related to pension plans, and the more we change them, the harder it is.
Yeah, and when you're fresh out of the change, you remember it, but a few years down the road, it's going to be a lot harder to remember those little nuances.
Well, I think it's not helped by the fact that these have been kind of open items for years. So, I mean, from my perspective, my first thought would be, how does the actuary miss that? But this has been ongoing since 2017. So, okay, I kind of understand that.
Do we have any questions or comments on this one? Okay, so entertain a motion to approve.
I move that we approve the defined benefit plan appendix B2 as submitted.
I'll second.
All right, any further discussion? All in favor?
Aye.
Aye.
Unanimous as well. Okay, so now we're down to old business. Item 6A is the pension plan mobility policy, and I know we discussed this a while ago, and we discussed this, I think, as the Board of Selectmen a little bit, but I can't remember where we ended up with it, and I know that had to figure something out.
We
And Jason,
ended up with it last time.
yeah, we're right, exactly. I think Jason asked me about it about 3 or 4 weeks ago, and I always said, sorry, I got nothing for you. I don't remember what we said.
So, I can fill you in on a little bit. So we talked about when people move from one bargaining unit to another that have a DB to a DC or from a DC to a DB, how do we treat that? And your guys' comments was, we want it to go with the contract. But what that does is doesn't leave us a retention tool. If we have somebody that's in one of our bargaining units and they want to switch to a unit that now has a DC, they're giving up their pension to do that. So I reached out to my peers and basically found out we're the only ones doing it one at a time. Everybody else closed their DB plan full swoop and opened the DC plan. So then it is, if you were hired before January 1 of 19, you're a DB person, no matter where you go. And if you were hired after January 1 of 19, you're a DC person, no matter where you go. So they have it a little easier because it's a set time where we're having this bargaining unit go, this bargaining unit go. So we have it a little more difficult. So I don't know, but it is a concern of mine about, we were kind of doing it on a case by case, but the town is always on the losing end. Because the ones that want the DB fight for the DB. The ones that are going from a DC to DB, of course, want the DB. So we haven't been on the right side of it ever in the cases that have happened. But I don't know that there's a great policy that would fit us for how we are.
So the only, am I right in saying the only bargaining unit that still has a straight DB is the supervisors?
Yes, and unaffiliated. And Board of Ed unaffiliated.
Board of Ed unaffiliated. So Board of Ed unaffiliated is the central office staff. So it's not likely that you're going to go from being the HR person to the cafeteria person.
No, but it's also all their occupational therapists, all their school psychologists. So there's a lot of other people in that unaffiliated other than the business office staff. Basically anybody who's either not a teacher or not part of cafeteria, janitorial, or paraprofessional.
Right.
Everybody else in the school is tied to the unaffiliated.
And so on the town side, the supervisors are the only ones in a DB. DPW has a hybrid. Clerical now has a hybrid. No, they're just straight DC.
Yep.
Um,
So the cases we had a clerical person who was DB, switched to dispatchers who were DC, she stayed DB. We had an unaffiliated person who was DB, switched to clerical, which was a DC, she stayed DB. We had a clerical move to supervisor, went from DC to DB. Are the 3 cases that I know of that have happened over the last 10 years, since the first group of dispatchers went to DC in 2007. But I think you could probably have a case where somebody was a dispatcher and then became a police officer if they went through the academy and got the training.
yeah, and that's likely to happen in the not too distant future. They have a couple of dispatchers who are kind of police officer potential.
So if somebody has 10 years of DC stuff now and becomes a police officer, they got to start all over again. I guess that's where the concern comes in about making a set plan.
Well, and
When
you
you
had an
say
example the other day. Sorry, Deb.
When you say start over again, they're not losing their already earned benefit.
No, but they have 10 years of service with us that now they start at day one with a DB plan and part of a DC in the police from 2007 forward for police. It's a small multiplier. So they're not really getting credit of those 10 years of service. Where if they just stayed in their DC plan, they might be better off. They got to start all over again vesting. They got 10 years vesting. So now they're committed that they're going to work for us at least for the next 10 years to be able to vest their new DB portion of their police pension.
So if you switch from a DB to a DC, you lose your vesting even though you're with the same employer?
No, they close off the year accruals.
Right, you don't get any more benefit accrual. So if you only have 5 years with it, you stay with 5 years and then you move over to DC and you start all over again.
And if I'm getting no more accruals, and so that plan is, for me, effectively dead, right?
Effectively closed. Yeah, you still have
Can
it.
I just roll that into my former yada, yada, yada?
No,
You don't get paid out once you're vested. If you're not vested and you change, you get paid out for whatever your contributions were. But
Then I would just roll that into an IRA and
yeah, so here's a real world circumstance that could have happened. Clark Chapin is 58 years old. He started with the town as a supervisor in the DB portion. In order to vest, he would need to get 10 years in.
no, 5.
Okay, so he would need to go until he's 63 years old. Where it may, hi buddy. It may have made more sense for him if he was in a DC bargaining unit because of his age. Whereas somebody like Amy Lamb, 30 years old, she could conceivably work for the town for another 35 years. It would be in her interest personally to be in the DB arrangement. I got to, because it's going to get loud.
But you can't give them the choice.
No, absolutely not. No. I'm just pointing out there, it's not all upside, for employees who are going into a DB. If you're starting with the town later in life, you have to decide whether you're going to make that 10-year commitment.
Or I decide whether I want that job. Do I want the package? The position, the pay, the benefits. You make an educated decision based on this is the packet that is available. I'm stuck on this in that I think that the benefit that we provide should be equal to the other benefits of that same person in that same job. So if it's a DB position, that's what they get. If it's a DC position, that's what they get. And they should simply be made aware of that. This is what you're going to get. Do you still want to take it? Yes or no? I don't see it as a retention position. I don't see it that way because they didn't have to go. We're not taking something away. They're choosing to make a decision to start a new career.
what happens for somebody that, went, into a unit that had a DC, they of course chose their DB. And what happens if we go, a little later down the road and we close that, with the next contract, we close that DB option for that originating group? What happens to that person? Are they hung out there? Are they getting closed up, paid out, whatever happened to the rest of the group they were previously in? Same thing happens to them, or is there something differently? How are they treated? And I wonder because, they don't have a vote, right? Because they're no longer part of that.
Don't we typically change those arrangements prospectively? So if you were in it at the point that change happened, you get to retain in it?
Right.
That would be my guess too, is that we would allow somebody to keep what they have. And I think in a lot of cases, if, say, somebody wasn't vested, you would make them vested in whatever that plan was before you closed it, before you opened up the new one. But I can't imagine us doing that anyhow. I mean, are we actually going to close an active plan, fell swoop, and say going forward, we're going to do this instead?
Not
Yes,
for 30
unlike-
years.
I guess I'm kind of feeling like Ed, where, you know, if you want to make a move to a different, if you want to now be a police dispatcher when you were wetlands official or whatever, okay, fine. You know, part of, that's what they get over there. If you like that, that's good. If not, you know, you can still be a wetlands official.
I'm feeling the same way.
So what happens in a circumstance where somebody goes from a defined benefit to a defined contribution and then back to a defined benefit? Another example here, Amanda Cal has a defined benefit from when she worked in the first selectman's office. She transferred under this scenario of you get what you get, or you get whatever the position offers. When she transferred to the clerical union, she should have not gotten her defined benefit anymore. She should have gotten a defined contribution. But if there's an opportunity now, 5 years down the road, for her to move up within that same department from the administrative person to the zoning official, she then would be going back from a DC to a DB. So in that case, if that were to happen, would you restart her clock, or does her clock start again?
Right, yeah.
The swapping back and forth makes it very difficult. And each unit having a different plan just makes this very cumbersome for managing staffing changes.
How often does that scenario pop up? Are we worried about the, 0.001% of turnover here? How many times in the last 10 years has somebody jumped from one benefit package to another and had an issue in that they felt slighted?
3 times that I know of.
Okay, in 10 years.
Yeah, because the first one was right after dispatchers went to DC. But each time they've talked their way into keeping their DB. I guess that's my concern, is that without a policy, it allows them that opportunity to get an MOU and keep their plan.
And I think that's a terrible way to do business, that you should not, that should not be a negotiable item from the prospective employee who's on the move. This is what you have. This is what you're going to get. Take the position or not. That's your call.
And I tried to do that and got told that, oh no, Bob signed an MOU. I'm good. I'm staying in the DB plan.
Well, that's why we need a policy that says something, and then we make it, cast it in stone so it can't be screwed around with. This open-ended negotiable stuff, this is not work, because this is going to end up in a court someplace.
Well, the reality is that even in a circumstance where there was a policy in place, if my predecessor
Did you guys see the chat from Rebecca?
Yeah.
She's leaving us.
So in that circumstance, even if there was a policy in place, and my predecessor had signed an MOU with that employee, the MOU would control, not the policy. So even then, it's not bulletproof.
Can that position, the first selectman, sign an MOU just because? Is there anybody that reviews it?
No, so the first selectman does not have the authority to enter into any agreements without the acquiescence of the Board of Selectmen, as long as he asks them for it. In that case, Bob just signed it and never brought it to the board. So
Doesn't that make it invalid?
well, maybe, but I don't know enough about that. I know that Alan will attest, we had a 20-minute conversation about an ATM contract in town hall because it's a contract and I can't just sign any contract I please. I have to get board's approval on all contracts.
And, and when in the case where Bob did what he did, okay, fine, he did wrong, but now how do you undo it? You got, you're off to court. So, which costs more?
Yeah.
Which will cost more now, but I mean, which one has the potential to cost more?
Yeah. You're right.
You know, if you leave it stand the way it is, and, you know, potentially one person gets the benefit, but if somebody else gets that idea in their head, and then there's, you know, 5 people want what she has, and then where are we?
And I moved 5 years ago and didn't get that opportunity. And I want you to make good on whatever benefit I was supposed to get. And, if that's not going to happen, then I'll go talk to my new best friend, the lawyer.
Yep.
I understand we can't rewrite, well, you can rewrite history. We can't change history. But I think going forward, the benefits for the position are what you're going to get.
Yeah, I agree. I think it's all part of the compensation package.
Yeah. And if that's part of the deal, if you want to move around, move jobs left and right, you know, in 5 years, that's what happens. If you did it in a, you know, from one company to another, or even from one subgroup to another, these are things that you have to face elsewhere too. So you don't want to make too many exceptions, because that's where you're going to get nabbed.
And that's why policy is the right way to go.
Yep.
Sounds like we're kind of coalescing around moving, getting what they got. That's all there is to it. And the only problem with that policy is somebody that's just flip-flopping back and forth. Amy's got a head scratcher every time.
Well, why would it not be? I spent 8 years in my DB position. I jump ship, go to a DC for a while, and then I come back to a DB position. And my very first day includes the 8 years that I had in the DB.
Well, there are 2 things about that. First of all, when the only DB that we have is the supervisors, and you need 10 years vesting for that. So if you have 8 years in it, you need 10 years to be vested.
5.
Is it age of 60? Why is Patty still hanging around?
It's 5 with 65.
Oh, okay. So Helen is vested at 5, but Patty's not vested until 10.
Well, no, she's vested at 5, but she can't retire without taking an early retirement penalty until she's 65.
Okay.
So I can leave at 62 and be vested, but I can't start collecting until 65 unless I want to take between 7 and 9% reduction for each year that I'm leaving early.
Thanks.
Yeah, we have huge penalties for early retirement here.
Okay, so we'll use that same example a different way. If somebody's been with us in a DB position for 4 years, and then they change into another bargaining unit that has a DC or a hybrid, then they're potentially not vested if they can't get back to a DB position. You know, there's only.
So we actually kind of have that scenario on the Board of Ed CSEA people. The Board of Ed people will not qualify some of their years because they don't make 1,000 hours. So when we calculate somebody's retirement, they could have worked for us a total of 25, but say only 20 of them did they make their 1,000 hours. When Milliman does their calculation, they only give them credit for the 20, but then they give them back their contributions for the 5 years that they contributed that they didn't qualify. So that's actually what happens now. And it could be you work 4 years, you don't make the next year because something personally happened or your hours got cut. Then you work the next 4 or 5 years, and then you have another couple years you don't make it, and then you get more years. So, I mean, they're always participants, but they only get credit if they get 1,000 hours. So that's the part-time at the Board of Ed is really where that comes into play, but it really already happens. So if somebody worked for us 4 years, went to a DC plan, and then got back to a DB plan, it would just be added to it.
I mean,
And now I guess we just need somebody to draft it. Jay?
I move to have Amy draft that as she just described it.
I think it's a team effort with Jason and Amy,
We also could just use the lawyers.
or that's probably better in the long run. So, I mean, I guess we gotta, Jason, because this will be a policy for the Board of Selectmen to figure out, right? We'll just have to
Ratify, yeah. Both boards will have to vote for it.
I promise if you bring this up within the next 6 months, I'll remember where we are on it. After that, no guarantees.
So I guess we will try to put a policy together. So for your next quarter, you have one to look at.
Thank you.
Amy, I'm pretty good on Thursday.
Okay.
Okay, well, if we're done with that, are we done with that?
Yep.
All right, then that concludes our business except for executive session.
Would you stop recording, Jay?
And that will include Jason and Amy. So if I could have a motion.
I move that we go into executive session to include the first selectman.
I'll second.
That was to include the first selectman and the finance director, I think, but you cut out.
Yeah, that's exactly what I said. I cut out.
All in favor?
Aye.
All right, so moved.
For an executive session at 7:08 PM.
Okay, we're out of executive session with no action at 7:24 PM. Is there any other business to come before the pension? If not, I would entertain a motion to adjourn.
I move that we adjourn this meeting effective immediately.
I like Ed's, I'll second.
Okay. After votes, all in favor?
Have a good night, everyone.
Good night.